Hey guys, welcome to this video. My free training is underneath if you want to grab it and change your trade today. And I did a stream yesterday as well. Don't forget to check it out on my profile. So this one is going to be relatively educational for those of you who aren't too aware of why I've posted so much about global index markets falling. We did just have Michigan sentiment preliminary results. Came in at 67.7. The forecast was actually 69. So a good miss there. Okay, you had University of Michigan 5-year inflation preliminary actual was 2.7%, and it was supposed to be 3. So what's that done? It's drowned the dollar. The Dixie's gone down. Okay, your SPX or your S&P 500. I've got the futures market up here. Is starting to fall on the day, and we looked short yesterday. Okay, I spoke about this short. I'd also done a full members analysis this morning inside my paid members area. Where everyone was introduced to that. But this one specifically is going to be based on the longer term. So for that reason, I'm going to start on the monthly. So as many of you will know, and I'll tag my previous posts under this video, I looked a lot at the very long-term market. And the very long-term market, if you look at things like this futures market for the S&P, the E-mini futures ticker ES1 exclamation mark, you can see there's been sustained growth for years and years and years and years and years. Now, 2009, you have your financial crisis, you start to recover after you get that big whooping, and it comes up and up and up and up. And for a long time, you've had this consistent growth. In many areas, you've had low interest rates, but now we're getting to the point where interest rates are really high. Now, interest rates and understanding them is a very basic part of economics. At the end of the day, what makes the world go round, more or less, in a monetary system is borrowing money. How much can you borrow and how much are you going to spend? Of course, interest rates are put up on purpose by the Federal Reserve, Bank of England, central banks, to basically control the monetary supply in the economy. Because at the end of the day, the rates go up to stop people spending money. That causes a squeeze, and therefore, people stop spending their money, and then businesses are forced to price their products lower. Essentially, their products and services drop in value. And of course, they put them up because they know people have got the money. But the key thing is here, and I saw a great post on this from someone else as well, pretty much the thing is, what people don't realize is that often when they put these rates up, the effect isn't there straight away. The effect actually takes a bit of time to come through. Now, if you're putting interest rates up now, and like the Fed said, that it's unlikely that they're going to drop them before the second quarter of next year, if you're looking at that, you would be thinking, wow, okay, well, my mortgage is going to cost more for a while, so I probably won't spend as much money. But you've got to think, if the rates are already high and people can't afford it now, what's it going to be like, next year when they keep them at the same level? It's going to be a squeeze and squeeze and squeeze and squeeze. So what happens is the economy retracts. The oncoming recession, which they're now reporting, is going to cause a massive issue. And you'll find that things are much tougher for businesses, companies, because people are going to stop spending that money. The growth stalls and stops in some areas. So you haven't quite got the full yet, because you haven't got to that point. Now, even with that is the fact, and it goes very much hand in hand. I teach people all around the world this a lot, and I find it very interesting. But you'll notice, as I said, I'll tag the video underneath in the description. But you'll notice when I said about looking at your 12 monthly chart and coming from 2009 all the way up to 2022, it's a massive, massive, massive rise. Now, even without the fundamental aspects, you would expect after an enormous rise to get a big fall. You had it on crypto, things like that. They are HVAs, but normally if you get such a massive rise, there's only one outcome in the end, and it causes a fall. So just from a technical basis, you could observe that. But the reason why you've had all that growth is exactly the opposite of the reason, basically the opposite of what's going on now. Now you're getting stagnant, and actually people can't spend any money because they don't have it. So for all this period, you've got all this great stuff. Okay, borrowing money is cheaper, and that can only go on so long until borrowing money can't be cheap anymore, and hence the interest rates go up. Now you'll notice again, as I said, because someone asked me about this as well. They said, okay, well, Will, if you think the market is going to crash, and you've seen that on a tech basis, when's it going to happen? Because people have been saying it for ages. I've been thinking it for a while, is what the person said. And if you look at your monthly, the crash hasn't occurred yet, has it? Because the only way you've come down is just to this area here. Now, we did reshort, as I said, via tech levels here. That was what I said to my members and many other people on my streams. But the point is, if you're looking at a 12 monthly chart, you'll notice that the rise previously from 2009 all the way to now has taken 13 or 14 years. Okay, so it's hardly like the crash is going to happen in 1 year. Sometimes it can, but if the price is going to significantly reduce, looking on a longer or higher time frame chart, naturally, one would assume that the move that is going to come is going to be in line with the fact that you've got such a high time frame that you're looking at. Okay, so it's really important to note that. As well as that, you can only see your 20 MA on the yearly. You're extremely far off it. You went all the way to 4,800 or so points. The MA only exists near 2,250. You're way, way, way above average, and eventually the MAs have to catch up with price. It's got to happen at some point. But really what you need to understand is, from a very basic perspective, interest rates take time to kick into the market to drag it down. Okay, and that will come in the form of recessions, businesses making less money, lots of fear in the economy, people liquidating their positions in stocks because they're worried what's going to happen. And then, you get global index markets, futures, everything that is reflective of those bodies gets dragged down. But you have to remember, whether you're looking at it from a technical or a fundamental basis, that takes time, just like you've seen in this massive rally. It's taken an enormous amount of time because simply it has to. You're not going to have a change in monetary policy which has an effect immediately. Okay, so you came off from the financial crisis, things start to improve. You've had that big reset, things went awfully wrong. You had the same thing at the start of the millennium, okay, the dot-com bubble, etc. And like I said, it's just going to take time to come to fruition. That's just how things work. If you look on a nearer term basis, you'll also find that you've got various levels of price action which are preventing an immediate fall as well. Okay, so this Michigan sentiment news, it may help slightly in the fact that it started to pull the S&P down at this point. And of course, like I said, you've got the dollar coming down slightly. But 67.7 as a reading, it fails to beat consensus. Okay, and that's why you've had the drops that you've had, because it's a miss on what was expected and it puts a bit of fear in the mix. So my bias remains short on the S&P and various global index markets. I think they've come up for too long. I think things have been rosy and great for too long. Okay, and you're now finding that it's all changing. But remember, that is a process that takes time to occur. You won't get that straight away in any scenario. It's going to take time. If you change anything in an economy, it's not like the next day suddenly everything's different. Okay, it just takes time to occur. So that's a full rundown. I'll tag the other videos I did underneath because they're mainly technical based. I did a stream yesterday, and of course, as I said, if you want to get my free training, it's right under this video. My bias remains short, and that is a very simple glance at the economic or simple economics of what's going on. See you in the next one.